What's going on, guys? Loose Move the Trader here. Wanted to make this video because a lot of you guys have been asking me about the ATR method, the average true range method, in order to figure out whether your stop loss is going to be taken out or if you have a better chance of surviving a whipsaw. So today on my chart right now, we are looking at a few scenarios here on the 1 hour. And I have an indicator down here that you guys can also download for free if you're on TradingView, NinjaTrader. Pretty much every single platform is going to have a variance of this. So what you want to do is just double click here. It's called the ATR. If you want to download it, you can just go to your indicators and type in ATR or average true range, and you're going to see something like this. I already have it on my screen, so we don't have to worry about that. Now, if you want to customize it, you can do that on your own time. You just double click it, and you will see that there's different options for you to make it a different color, different style. You can use a different moving average. That's all up to you, but we're not going to get into that today. What we're going to do is show you how to utilize the ATR in order to make better educated decisions when it comes to what stop loss to use. So right now we're on the 1 hour. As you can see on the 1 hour, I've highlighted these areas so you can see that on a few different sessions, New York sessions, we see that we had these spikes. Now, this spike was really big. This one was a little bit smaller, and then this one was a lot smaller than this one, right? So we have a couple of scenarios to go over here. So with the first one that we have here, we're gonna dive in here a little bit deeper. We're gonna go into our 15-minute because I know a lot of you guys are not trading on the 1 hour. We're using something smaller, so we'll use a 15 just to kind of give you an idea of how to use this information. So I've highlighted this section here to this section here because this is when I saw the ATR actually start to kick up, and this is when I saw the ATR actually start to go down lower. Now, what the ATR is the average true range of the size of the candles. So when you see a number, when you highlight this area and then you look over to your right, you see these numbers here. Wherever you are on this chart, it tells you what the average range of a candle is for that look back period. So right now at this period, when we start at 6 a.m., I think it's 6 a.m., 6:15 here, we see that the average true range for a candle is about 22. So it's pretty low. If you look on the graph, it's pretty low compared to as high as it got or as low as it's been. So we know that, but we're not going to take an entry here most likely. We're going to give you a scenario where we're going to take an entry right in here at this 7:30 candle, this blue candle that's right here. We're going to take an entry here. So we're going to set up a position. Let's see if I can get in here, a long position. So let's say that you saw this blue candle and you said, well, this looks like it's going to bounce. We're going to get a rebound here. We're going to go higher, maybe test a high of the overnight session. So we're going to go here and we're going to plot our trade. We're going to say, all right, if I enter, if we retrace this blue candle and we come back in this area, I want to enter the trade. So we plot our trade. We look for our target. Let's say we want to target maybe 420. Let's say we want to target 420, and we want to come up with some kind of a formula for where should our stop loss go. So when we entered this trade, our trade at 7:30 here, or let's say it was 7:45, the average true range of a candle was 39. So what we want to do here is come up with a factor. Are we going to use 1? Are we going to use a factor of 1? Are we going to use a factor of 1.5? Or are we going to use a factor of 2? Now, the only way you can come up with that answer is by trial and error, do some back testing, and see what you're comfortable with. But what I'm going to tell you is that the higher the ATR means the higher the volatility, which means the higher the chance that you get stopped out. So what I would do in a situation like that is if the volatility is higher, we use a higher factor. Let's say we use a factor of 2. If the volatility is low, then we use a factor of 1. If the volatility is somewhere in the middle, then maybe we use a factor of 1.5. Now, I'm not telling you to take these kinds of trades. I'm just giving you an example of how you can utilize this information to craft your own strategy. So since we know that the average true range on this candle was about 40, we're going to say that 1.5 times 40 is 60. So we're going to give ourselves a stop loss of about 60 points. So we're going to put our stop loss here. Okay, 60. And we're going to have a take profit there. So our risk to reward right now is about 2.6, which is not bad. This is pretty good risk to reward. So if we let this play out after we entered this candle, we saw that we not only came up barely missing our take profit, which, you know, it happens sometimes. You know, we don't always get there on the first time around. But this move actually came back on us, and this is when you start to sweat. Did our stop loss get taken out? No, actually didn't. It double tapped the lows, almost double tapped the lows, and then came back, and then we hit our take profit. Did it take a little longer than we would have liked? Yeah, it did. It didn't hit till around noon, but we had our take profit and we were safe in this trade. So I know you guys are thinking, hey, I don't trade off the 15 minute. I like to take my trades off the 5 minute. Okay, fair enough. Let's go to the next session here and say, is there a place where I could have gotten in here on this 7th of January on a 5 minute chart? So let's break it down to the 5 minute chart. We had a little less volatility on this day. I've highlighted the spikes of the sessions where we had the most volatility and where we kind of died off. So what we're going to do is we're going to look for an area that we would have been interested in. So we got down to this area here. This area looks pretty interesting. Okay. We got a nice signal here because we had a big volume candle. These volume candles a lot of times get retraced about 50%. So let's just say that we were interested in entering this long position here. And I'll do a short too on the next scenario, but I'm doing another long scenario right now. So we saw this candle. We said, all right, well, we're going to wait to a retracement of 50% of this candle to get in the trade. So we got into the trade at around 7:55 a.m. So let's plot our trade once again. We go down here to the ATR. And we look at the ATR at 7:30, and at 7:30, the ATR is at 31. And once again, it's at the middle of a range. So 31 on a 5 minute candle is pretty big. It's not small, but it's somewhere in kind of the middle of the range for what we've been seeing recently. So 1.5 times the 30, let's say, is roughly about 45. So we're going to give ourselves a 45-point loss. I know this is pretty big, but you don't have to use these numbers. I'm just giving you examples here. Craft your own strategy. And we're going to give ourselves at least a 2-to-1. Let's see how high we should have kept our, let's say we want to target all of these high volume candles on the left hand side. All of these are high volume, which means that there's probably imbalances in here, and we could take advantage of filling these up, which they usually do. So right now we're looking at a 3.7 risk to reward, which is great, guys. It's a really good risk to reward. So we let this trade play out. We have a 45-point stop loss. We have a 100-point TP. And as we can see, our stop loss was safe. Even if we would have used a factor of 1, we would have been okay here. But we saw that we eventually, not here, but we came back down, retested the lows once again. Our stop loss was safe. And then finally we came in to about this point in time here, and we would have just barely hit our target. But you see how the market likes to come back to these levels. That's a video for another day. I actually made a video on this. If you guys want to see that video, I'll link it right here at the top on how these high volume candles act as magnets. And that's a really good video. You guys should check that out. But as you can see, the market did eventually go there. Now, if you want to be a little more conservative, maybe you target about 80 or 90% of these high volume candles. That way, you know, your stop loss will get, your take profit will get hit much sooner than what we got in this scenario. But the point of this video is to make sure your stop losses are safe. And in this case, once again, stop loss, safe, TP, secured. Beautiful scenario here. Okay, let's check out a short now on an even smaller time frame. So we're going to go down, we're going to go over here to this day where we had less volatility, and a little bit less volatility than we did on the last 2 days that we just saw. Now, on this day, we're going to drop down to the 1 minute because I know some of you guys like the 1 minute, right? We're going to do the 1 minute. Okay, so here we are on Monday, January the 6th, and this was one of the hardest trading days I have ever seen in my life. And this is actually a good scenario to show you guys because it's an extreme opposite of what we've been seeing. So we are on a 1 minute time frame, and we're going to see about taking a short position. So what we're going to look at is, okay, we are getting here a higher highs, but the ATR is dropping, which means that the power of this move is weakening. So let's just say that we wanted to wait for this wick here, a takeout of these highs, take out the liquidity from up here. Let's just say that's what our trading plan was. we'll say the minute we take out this liquidity, I'm going to go into a trade. So I want to go into any candle that goes above here. I want to short that. So we look at this candle here at 1111 and we look at the ATR, and the ATR is very low. Right now it is at 11 compared to as high as it was that day at around 27, almost 30. So if we're at an 11 and we're low, actually that's crazy. This traded at 1111 and the ATR is 11. That's pretty crazy. All right, so let's just say we entered this red candle that we see here. We entered this one. Let's just say that we entered it around, let's be conservative and say that we were waiting for a break of that. We're waiting for a break of this level, and we snatched up. We were able to really take a really sniper entry right about here. We entered the trade right about here at 21,891. And let's just say that our factor here of 11 is what we're trying to use as an ATR. So if we use the factor of 11, our stop loss would have been here. Stop, 11 points right there. Okay, 11 points. And then we go with a TP, take profit, and we're going to target, right? We're going to target something that makes sense. Remember, we're scalping here. So we had these recent lows here, these recent wicks, this area of supply here. I'm sorry, this area of demand here. There's a lot of wicks there. So we targeted that right there. So right now we're looking at a risk to reward of 2.42, and we let this trade play out. We entered it right around here. What we saw is that the trade not only came back up, but it didn't go into our stop loss. We were safe. And then we came down and we hit our take profit, even though the trade came against us. Trade came back up. We're safe for a second time and came down and we hit our take profit area. Okay, so this worked out for you again. Now it's not going to work out every time, but keep in mind what I'm showing you here is that in this scenario, the ATR was low. So we only used a factor of 1. We did not use a factor of 1.5, and we did not use a factor of 2. So what I would say is if you're below the 50 here, maybe you want to consider 1. That's what I would do. If we were right in the middle of the range, we'd consider 1.5. If we were at the top of the range, then we'd consider a factor of 2. But remember, you always have to make sure that your risk to reward is at least 2 or greater in order for you to have a winning average overall. You may not win every trade, you may win 50-50, but as long as you have a 2 to 1 or greater on your trades, you'll eventually be profitable. So that's the way I would play this, and that's the way that I utilize ATR to find out not only what kind of volatility are we getting in the market, but how much can I afford to actually put on as a stop loss. Now, the last thing I'm going to tell you is if you do not want to put a bigger stop loss, you want to continue having the same stop loss, you can always use the ATR stop loss without changing the factor. So let's just say that the average true range is 11 and you want to use a 1 factor. Okay, now let's just say that the ATR is over here and the ATR is 26 and you want to enter a short. The problem is that if you want to enter a short and your ATR is 26, now you have to risk 26 points in order to have a stop loss that's not going to get hit. Now, that is probably the better way to go about it. But if you're the type of person that says, no, I always want to use the same size stop loss, which is the size of the ATR. But what I want to do is I want to reduce my risk when the ATR is higher. So for instance, if you take a trade when the ATR is high, then maybe what you do is you risk 1 micro. When the ATR is in the middle, maybe you use 2 micros. And then maybe when the ATR is very low, then maybe you risk 3 micros or minis, whatever it is. Or you can use 10, 20, 30 minis, whatever, it doesn't matter. You just want to use different risk at different ATR levels because you have different volatility, which means that the market can move against you at a different rate. It can move against you faster. So either you play around with a bigger stop loss with the same size, or you play around with different size of contracts with the same ATR, always the ATR that's shown on the screen. So that's the 2 ways that you can utilize ATR in order to make sure that you do not get hammered or you not get taken advantage of in a situation where the volatility can go up or down in a short amount of time. Now, in the markets that we've been having recently, we've been having very thin books. And if you don't understand how to read the volume in the market and how much is normal volume versus complicated volume, like when there's not a lot of people trading, those orders can be moved very quickly. That makes the ATR spike and go down. So the easiest way to read that would just be downloading the ATR indicator and checking out for yourself. If you have doubts of where the ATR is throughout the day, just check it in once in a while, in the morning, in the middle of the day, and at the end of the day if you're trading all day. So if you guys thought that this was good information, we have a lot of other training videos that you can find on our here on our channel or on our free Discord, where we have a whole catalog of everything you would need from beginning to very advanced stuff. I'll invite you guys to check it out. It's pinned down in the description, so check that out. If you want to see another video from us on how to read other market factors, go ahead and check out the video on the screen right now. I'll see you guys over there in just a second. Thank you for watching. I love you, and I will see you next time.